Greetings and welcome to the inaugural broadcast of the Real ROI of Tech. It's a joint podcast between TBM Council and the Technology Economist. My name is Matthew Guarini. I'm the executive director of the TBM Council. I've been a CIO in the past. I've worked for multiple technology companies, and I've been leading the council for the last 18 months. So I'm excited to be here with you, and I'm joined by Howard Rubin of Technology Economist. Howard, introduce yourself, please.
Hi, I'm pleased to be part of this today. I have a academic background as a professor of computer science and an operational background as a really consultant to the area of technology economics. And I've been doing this, as you can tell by age, probably more than 30 years. And the world's largest database of benchmarks and all that stuff really came from work I've done. So I'm very pleased to be here and partnering with the TBM Council again.
Excellent. And so what we're going to try and do, like the name of the podcast, it's the real ROI of tech. For too long, technology has been seen as just a cost center. And where the best companies are winning these days are by
Mhm.
delivering business value with their technology investments. And so Howard and I are going to explore that. And where we wanted to start is let's get some foundation set. And Howard, two of the things that I always talk about are one is tech is bigger than ever, and it's more important than ever before. Can you talk to us a little bit about your observations on both of those dimensions?
Yeah, and one thing I talk about, and again, I bring up the concept of the technology economy all the time, just to see how big this thing is. If you look at worldwide technology spending, and you'll see estimates coming from analyst firms such as Gartner and the 5 trillion mark, when you start adding in the in-house IT that companies are doing, you're pushing 8, $9 trillion. So why is that interesting? Well, the world's largest economy is the US at around 25 to $30 trillion a year, followed by China, which is over 10 trillion. So the third largest economy in the world is the technology economy. And that's how big this thing is, spread out all over the globe. So it's fairly amazing that the macro numbers have gone up. And when you hear everything going on about AI today and any new innovation came to cloud and everything else, things that was supposed to reduce cost, increase cost, and AI is requiring a massive amount of money and funding for data centers and everything else in the trillions of dollars. So technology is going to become more intense than ever. And the question you see in in the media every day is, if you're old enough, there was a commercial that said, "Show me the beef." I don't know how many people listening to this even know what I'm talking about, but it says, "Show me the money." I mean, this is Jerry Maguire stuff. Show me the money. What is the value of technology? And companies are not able to do that because they don't know how to measure it, how to quantify it, or maybe they're just not getting it. So this is the number one issue: is spend on one side, get outcomes on the other, and that's what technology economics is about. And that's what the underlying models that you talk about in the TBM Council and all the structures they put together.
So I think to your point there, Howard, you were at our conference about 5, 6 months ago. You showed an interesting chart. I'd love to walk people through. And I think the question you posited to folks was, are is technology returning value right now? And what would be your conclusion there? And walk folks through it.
Yeah, so the chart that Matt is talking about was from a presentation I did at the executive session at the TBM Summit in Miami in early November. The amazing thing is, I said, I have all this data, and I went back 25, 30 years in time and said, what are the big things that happened in technology that affected business? Well, clearly there was e-commerce there, and then you started to get things to blockchain, and then you got, I'm skipping a bunch of stuff. You had cloud, and then now, then we get to AI, and I guess we're going to quantum. So I produced a chart of 25 to 3,000 companies over that period from the mid-90s to today, and just looked at a timeline that showed when the technology was introduced and what happened to their margins. This is for profit companies. And I expected to see inflection points. Well, guess what? There were no inflection points for the average companies. There's some that are breaking away. And the weirdest news, and I had this part of the diagram look like flatline from a bad TV drama on medical stuff or something, but the thing flatlined after a while because actually margins for most companies were higher in mid-90s than they were today. And that was an interesting fact. Not that there aren't breakaway companies, so don't get me wrong, but the companies that weren't adopting tech were falling off the map, and those that were using it, very few got demonstrable value. And that's the problem that remains today.
So the question I think a lot of people want to know is what are the characteristics of the breakaway companies? Like, so to your point, you're looking at a macro analysis here, where on the average, everybody is, at best spending to maintain, but we do see some people that are creating some real value. What are some of the things that they're doing that are setting them apart?
Yeah, and, actually, it's interesting. So this sounds like a infomercial, but if you look at the TBM framework, at the top line of this thing is that that's produced value. And the interesting thing is the companies that are interested in technology and trying to get value out of it, they're just not managing their projects as being on time and on cost. They're worrying about on scope and on value. So they're targeting value and value metrics, and more than being on time and on cost, whatever the heck they're implementing or doing, whether it's a new technology or a system that uses business application that uses that new technology, they understand the value-based metrics, whether it's business operational efficiency or effectiveness, or it's customer, or relates to getting new products to market and other things for regulatory, and they're targeting those things. So they're managing projects in multiple dimensions and understanding also the timeline of when the value materializes. So it's like
Mm.
making an investment, but having the patience. And I know I wasn't asked this question. The biggest failure in AI right now to me is one of failure of expectations. You don't do it the next month, you're getting AI benefits. And that's one of the issues about it. So it's managing projects in a new way, focusing on value and refreshing it when scope changes and time changes and cost changes to see if the yield's going to be there, and then going backwards and saying, I've got to get there. How am I getting there? What's my time to close? And managing toward value. So that might sound trite, but this is like having an unguided missile. When you drop a technology in, you don't know where the value is going to show up. And that's a big problem.
What would be your expectation? So your analysis showed the flatlining of margins, even though we're investing more and more tech every year. We just talked about that at the beginning of the podcast. So what would be your expectations as the amount of investment now from AI starts to flow in? What's the short term impact? What's the longer term impact of that
Yeah,
AI?
it's really complicated in some ways because as you watch what's going on with the trillions of dollars or billions of dollars you want to be invested by the NVIDIAs and the Microsofts and the Amazons and everybody on the supply side of the equation, IT inflation is in place too. So
Yeah.
IT inflation is about 7%, and the average company, according to the Gartner IT KMD report, is only increasing the budgets by 3%. So think of all the forces you have at work. Budgets aren't increasing fast enough to pay for what the supply side has. The supply side is getting, you see this in Microsoft just recently with changing the pricing of Copilot, is getting more expensive. So what I expect to see in an ideal world where IT inflation was out of the picture, we start to see increases in margin, increases in business operational efficiency, using AI coding, getting things out to market faster, so faster product deployment, and all sorts of good things happening. But the wind shear forces, the headwind forces are the costs, the learning curves, and other pieces. So I have this thing I just wrote on what I call the AI paradox. The paradox is the companies that really need AI probably can't afford it.
Yeah.
Those that are getting into early aren't getting the benefits, so it's hurting their operating margins. But this is all short-term effects, and
Okay.
short-term effects you have to get past. And that's why you need the long view of where you're going with a target, but also integrate all these technology economic factors from the cost side, from the inflation side, from the skill side and the learning side. So it's a big I don't want to use the word ecosystem. You use that a lot also, but it's a bunch of interaction of forces and dynamics that have never been encountered before in a form like this. And that's good news and bad news because that's going to happen with quantum computing too, and
Yeah.
whatever comes next.
So let me ask you this one. So you gave me a good understanding on the short term, and then you talked a little bit about the long term. And when you think about technology, it's hard to really have one metric that really evaluates where you are in terms of how much value you're getting from your investments. But I know your company's been doing some work around a metric that does that. Do you want to talk about that real quick?
Yeah, so this is the professor in me coming out, becoming practical. And what happened is I found that most companies, even going out to boards and stuff, people are looking at IT as a percent of revenue and IT as a percent of operating expense, and looking at metrics one at a time. So I developed, and we have documentation on it. We can easily share it and you can look it up on something called IT intensity, which of all things got a patent. But it looks like the interaction of IT spending relative to revenue and operating expense for profit companies And between the two of them, and the model really is very simple. It looks like a right triangle with those two variables on one side. But the hypotenuse is something I call the IT intensity. And of all things, you take 9 million data points of 30 years and you lay it across sector by sector, and you get a parabolic curve with a high fit that says this is IT intensity. And that parabolic curve is absolutely operating margin, if you wish, or its return on equity. So we have a correlation that's not linear. Having IT intensity does not guarantee results unless you're outperforming the curve, but you could easily compute IT intensity. TBM Cancel has the Ask TBM tool, which allows you to basically compute your IT intensity just from a few characteristics and lay you against the performance frontier of the best performing companies getting value at your level, and you can do a diagnostic of what you got. So it's a simple way of answering the question, does it appear we're getting value out of our IT investment? And if you're not getting value, I'm sorry for the long answer, but maybe too much of what you're doing is going in to keep the lights on, or maybe you're
Mhm.
not investing a month, or maybe it's both, or maybe your investments aren't targeted at value, so you're scattering all over the place and throwing money out with a wing and a prayer, they used to say. So, but
What
IT
makes
testing lets you see it. Yeah,
what makes that tech intensity really interesting is one, simplicity, right? It's one metric. But then the other one is it's a powerful one, right? Because it does bring in the outcome based side of things, right? So
that's
you're
right.
really thinking about the return on that tech investment, which is the second one. And then the third one is because you have so many data points across so many industries, you have the ability to effectively benchmark your your performance against a bunch of peers in that data set. And when you do that, like you said, if you're above the curve, you're doing well. If you're below the curve, you have some work to do. But also, you can be on the curve and still have some challenges too, right? Because
Agreed.
because of the parabolic shape, everybody wants to be at the top of the parabola, but you can be on the downside, and sometimes that's okay, but sometimes it's not.
Yeah, and a good point is because what the parabola is based on, it's just not all the data points, it's the top performers in there. So the performance frontier, why it has the name frontier, is that's the profile of best in class. And traditional consultancies will tell you best in class at running IT the cheapest or something like that, or have the least personnel, least impact on operating expense. That doesn't work. Best in class is measured by looking at business performance and metrics that are important to you, then working backwards to understand what's the technology economics, what are the patterns of the best in class? And that's what this whole thing is about. And best in class isn't having lowest cost, it's having the highest yield at whatever cost you have. And that's the exciting thing about this IT intensity. It's a quick diagnostic. It leads to more questions than answers, but at least this time it's the right questions. What are the drivers that we're not getting the value we expect? And by the way, this is new news. I have a new metric that's going to look at a yield metric. So it's going to be actually able to look at your level above the performance frontier and your level above the optimum and give you a ratio that really answers the question, are you getting consistent value with the level of IT intensity you have? And that's first coming out in the next couple of months.
Excellent. So, a couple key takeaways for everybody from this episode. So, the first one, as Howard talked about, is the size of the global IT market is much bigger than people think, right? Because we're looking at the all-in cost. It's about $1,000 per human on the planet when you really look at that.
Yeah.
But the challenge that we're seeing is we're really not getting the value we need. And this is where something like TBM can come in.
Right.
We invite you to check out the TBM Council. We've got a lot of free resources out there on how to start with TBM, how to accelerate with TBM. But we also have a benchmarking service that Howard alluded to. We've partnered with the technology economist team, and we've got some great benchmarks, including the IT intensity metric that's out there. So these are all things that you can use to get ahead of the game. Next time, we're going to come in and we're going to deconstruct the ROI to help you guys understand how we think about it and how you may want to start thinking about it for your firm. Howard, any closing words from your side?
No, I think that's a great summary. I mean, considering that Matt said technology economy is like $1,000 a person. So, Matt will send you a free coupon for an iPhone every year for everybody on the planet. Yeah, I'm just
I don't
joking.
know if my nonprofit can go that far. I would love to, but we'll find
Yeah.
ways to definitely help you. But
Okay.
for now, everybody, this has been
Okay. Yeah.
great. We will talk to you again in a couple of weeks, and you can find this on YouTube if you're out there. Give us a like, and we'll hope to be talking to you soon. Bye now.
Okay. Thank you very much, Matt. Good to talk to you.
Good to see you, Howard.